Hello, everyone. Thanks for joining us again here for our second educational session with the Board Retailers Association. We have Doug Works and Coco Tihanyi, along with the legendary Paul Erickson, to deliver our session on embracing the new metrics in retail, how to ride the wave of post-pandemic success. Before we get into the content, though, I did want to go over a couple of housekeeping rules here. If you'll advance the slide, please, for me, Paul. So GoToWebinar offers a few different options for audio. Please choose the control panel option that works best for you. And we are going to do a live Q&A at the end of this session. So you're going to want to submit your questions using the questions panel in the control panel there for GoToWebinar. And the most popular question that we always get is a recording. If you have to leave or if you weren't able to join us today, we are recording the session and we will send out a recording of it after. So let's go to the next slide, please. And just if you aren't familiar with Management One, thank you for joining us today. Who is Management One? Well, what we do is provide financial security for independent retailers, for our clients and our retail experts. And we do that through a focus on merchandise intelligence and education. We also operate under a set of core values, including a generous heart, courage, curiosity, adaptability, commitment, and collaboration, like these educational sessions here. Also on the vein of collaboration, I'll turn it over to Mr. Doug Works to speak a little bit about how Management One and Board Retailers Association work together. And thanks for joining us, Doug.
Absolutely. Thank you so much, Nico, and thank you for your support. For those of you that don't know, Board Retailers Association is a nonprofit that's been around for almost 20 years. We provide resources to help board specialty retailers remain competitive and profitable. We do that by helping to lower day-to-day costs, help increase profit margins, and to help to create remarkable customer experiences. We are really able to do that through our supporting vendor partners. Nico mentioned collaboration. We're huge on collaboration, and we're especially excited about our partnership with Management One. This is our second quarterly collaborative webinar of 2021, and we're super excited about what Management One brings to the table from an educational standpoint and an experience standpoint, and we're really excited to have all of you here to join us. If you have any questions or would like to learn more about Board Retailers Association, just DM us through Instagram or Facebook, or contact me at doug@boardretailers.org. I'll turn it back over. Thanks so much, guys.
All right, thank you, Doug. This is Paul Erickson, and welcome to our webinar today. I think it's going to be a little bit of fun. We're going to talk, maybe raise some eyebrows a little bit on some different ways of looking at your inventory and how what we believe at Management One, how the pandemic has really, changed many things in terms of what we should be considering as we move into a post-pandemic retail world. I like to talk about, as I do seminars and webinars around the world, literally, I talk about how being a retailer is it's really hard. That's why we brought Coco in with us, because she can share with us about how, look, retailers, y'all work long hours, you're working weekends, sometimes you have to work holidays. The customers all think you're super rich because you own a store. You're in a business where in retail, you can never be 100% right with inventory. If you think about it, it's almost impossible to be perfect. It's like a dartboard where you cannot hit the bullseye. You just got to get as close as you can. In other words, you either bought a little bit too much and you had to mark it down, or you could have bought a lot. I could have bought 3 times what I actually bought, and I still would have sold it all because it just blew out. And also, we just have contended with maybe the biggest challenges we've ever faced as in our profession during the pandemic. So it has led, I think, to a lot of confusion as we work our way out of the pandemic and back to a new sense of normal. I think that one of the things that we talk about at Management One is that what data should we be looking at? We want to talk about maybe some new metrics to be looking at, that you should be looking at as we move through 2021 into 2022. But one of the things we've said for a long time is that, we love our POS system partners at Management One. They're great partners, but sometimes expecting your POS system to control your inventory is a little bit like you're expecting your bathroom scale to control your weight, because the POS system essentially measures real-time transactions, but it really doesn't predict or control how much inventory you should have, and that is all part of what I think that a lot of independent retailers struggle with, which is, I know I need to use data to make better decisions. I think everybody agrees that even now, as we move into a post-pandemic world, data has become more important than ever. But really, what data should I be looking at? And am I looking at the data correctly? And, data can be confusing. Math can be confusing. And as an example of how confusing math can be, we'll take a look at a quick video here that Nico's going to roll up very quickly here.
I will get you going here, Paul.
I figure 75% to you, Pon Ma, and 25% divided between the 5 of us. Yida, Crowbar, myself, Tom, and the baby. That makes 5% for each one of us.
Billy, you're cheating yourself. If there's 25% divided among the 5 of you, that's 14% apiece.
Oh, no, listen, Pa. I wouldn't cheat you. You know I wouldn't. Now, look here. I'll show you. Let me rub this out here. And now, 25 divided by 5 is 5. You see, 5 won't go into 2, will it? No. But 5 goes into 25 5 times, you see?
No, you're wrong, Billy. Now, I'm a pretty good mathematician. Now, 5 into 25, 5 won't go into 2, will it?
No.
But 5 goes into 5 once. Now, we didn't use the 2 before, so we bring it down here. Now, 5 into 20 goes 4 times. There you are. 5 into 25, 14.
No, look, Pa, let me prove it to you now by multiplication. 5 times 5, 5 times 5 is 25.
Really, I'm surprised you're learning.
Huh?
I'm surprised that you're learning. Now I'll show you. 5 times 14 is 25. 5 times 4 is 20. 5 times 1 is 5. 25. That's it.
No, look, Ma. Look, you're wrong there because I'll prove it to you. We'll put down 5 14s here. 14, 14, 14. There. Now I'll prove to you by addition that 5 14s is not 25. 4, 8, 12, 16, 20.
21, 22, 23, 24, 25. There you are. Better brush up, Billy. I don't want to see you boys cheated.
That one gets me every time, Paul. Let me turn it back over to you here. There you go.
Okay, so let me get everything set. That was worth a little bit of a disruption, I think, to show that. Oh, we don't want to show it again. So hang on just a second. Just let me just move past here. It's a little, and we'll be ready to go. Okay. Okay. I love that video too. Thank you, Nico. It is, I think it really kind of shows how confusing math can be, and we can make math come out any way we want to if we're creative enough. Look, one of the things that there were certain retailers that proved to be very vulnerable during the pandemic slowdown, and I think there was a common narrative that had went on during the pandemic that the slowdown really affected, if you were in a mall, you'd be affected negatively. If you were a department store, you would be affected negatively. If you were stores that were selling apparel, either to men or to women, your business was affected negatively. If you sold shoes, your business was affected negatively. If you were a luxury store, your business was affected negatively. And in each one of those cases, what we believe at Manageable One is the common narrative is incorrect, because I can give you example upon example in each one of those verticals that I just mentioned of retailers that did surprisingly well during the pandemic. There was only one type of retailer that struggled during the pandemic, and that retailer was pretty much universally negatively affected, and that was the retailer that had too much debt. If you look at retailers that were overly levered, those are the retailers that not only struggled, but actually were the vast majority of the 20,000 door closures that happened over the last 13 and 14 months. What was that factor? Well, what too much debt means not enough liquidity. And what that means in the future is that the new KPIs, the new measurements that we're going to talk about over the next 45 minutes is measuring cash flow, which is absolutely everything. And why that may seem like an obvious thing that all retailers have done in the past, we hope to show you why that has not necessarily happened. Now, when we talk about retailers that had too much debt, I'm essentially talking about two different types of retailers. We have the first retailer is, and let me get this going here. The first retailer is really, these are the chains. And they had, and the chains that really were having problems before the pandemic and that were crippled during the pandemic were the chains that were purchased by private equity money. Now, I like to use several examples of that. I'm from Wisconsin originally, and from Green Bay, Wisconsin had a chain of stores called Shopko. Anybody that lives in the Midwest will remember the Shopko chain. They had 350 stores. They were bought out by a private equity firm called Sun Capital. And what Sun Capital did to Shopko is what happens with a lot, and why these stores became very, very vulnerable. They loaded them up with over a billion with a B dollars in debt. Shopko had a very valuable asset, which was most of their stores, they owned the real estate. One of the first things that Sun Capital did was sell all the real estate. And what they did was then they took that cash, but required the company to lease back its own stores. They had to pay a $50 million dividend on a yearly basis. They had quarterly consulting fees to the private equity firm of over $1 million. Shopko had to pay an additional 1% consulting fee on certain transactions. The point is that they were robbed and stripped of their assets. And what that did was they created onerous debt levels. The biggest issue that private equity is the enormous debt burden it puts on these retailers itself. And that debt burden was essentially to facilitate the buyout to begin with, because the debt then falls on the balance sheet, not of the private equity firm, but of the actual retailer. And that is what caused the bankruptcies. These were severe consequences pre-pandemic, where private equity owned businesses were twice as likely to go bankrupt as public companies. Between 2012 and 2019, 10 of the 14 largest retail chain bankruptcies were from retailers that were owned by private equity firms. In 2016 and 2017, 2/3 of retail companies that filed for bankruptcy were owned by private equity firms. And that was the pre-pandemic. During the pandemic, these retailers were crushed because as sales started to go down, traffic started to go down, they did not have the equity in the business to really survive. That's number one. The second part is us, the independent. Now, independent retailers that had too much debt were generally caused by the fact that they had poor inventory management. You have to consider that when you're selling shoes, apparel, outdoor, sporting goods, 50% of the cash going out is to inventory. And so more important than ever right now is how we look at our inventory investments so that we do not get into a crisis relative to debt. We do not get into a crisis relative to knowing that the inventory is an investment that we make. And to do that, I think we have to understand metrics. Now, metrics have been an important part of retail. A lot of people call them KPIs or key performance indicators, but they're a really critical part of it. They're your scorecard. And it's very similar to how a pilot will fly a plane. He has to trust his instruments. Retailers need to trust their metrics. But what's happening right now is that while retail continues to evolve and continues to adapt, It is increasingly critical, we think, at Management One to develop a newer, more relevant set of metrics to accurately value and measure retail performance. Because the past suite of metrics, we believe, were built for a time that actually no longer exists. So what are those metrics? What am I talking about here? Well, I'm actually talking about something as basic as profitability, believe it or not. What is retail profitability? The question is, how much am I making money on my store? Am I making a profit on my inventory? You know, sales are obviously great to have, but the real reason people go into business is to make a profit, earn a profit. And gross margin lets you know supposedly how much profit you're making when you're buying and selling inventory without including, obviously, operating costs such as wages and rent. But is profit enough? Now, Webster defines profit as a valuable return or a gain. But profit, as is generally understood by most retailers, is what you get to take home after the bills are paid. So the question becomes, why is it that in the past, so many retailers so very often say, my accountant says I'm making money, but I can't even pay my bills? My accountant said my profit was so great that to pay the tax on the profit, I had to go to the bank and get debt even more to pay the tax on the profit I'm supposedly making. That sounds like a weird statement, but it's been true for too many retailers over the years, because apparently making a profit isn't really the entire equation for success in retail. So what's missing on this? Well, let's start with the fact that this concept called cost of goods sold in retail has been and can be the most misleading metric in retail. Everybody's sitting down, I hope, and the accountants now are getting up and they're probably having a heart attack as I'm saying this. But why would I say that? Cost of goods sold in accounting is actually the foundation of how your gross profit is being calculated. It's the cost of goods sold, which essentially it is misleading because it is what it says it is. It's the cost of the goods you sold. Let me give you an example. I bought 50 widgets for my store. I had great markup on it, by the way. I paid $3. I can sell them for 10. Woo! 70% markup. Bought 50 of them. After 5 months, I sold 5. My cost of goods sold was excellent, 30%. My cost of goods purchased, or your cash flow, was horrible because I had to pay for 50, but I only sold 5. Mm-hmm. That is why that is the most misleading metric in retail. This is part of the new suites of new that we need to look at. Let me explain how this happens. Let's do a I am not an accountant, but I do play one on TV, Doug, just so you know. But let's do a financial statement. Let's look at a P&L where your accountant tells you that your store did $1 million in sales last year. So let's just do a basic P&L. Your beginning inventory was $250,000. You purchased $700,000 worth of merchandise. Your ending inventory was $350,000. And so what we do is we take the beginning inventory plus purchases at cost less ending inventory equals cost of goods sold, which is $600,000. We then take our sales of $1 million, subtract the cost of the goods sold, equals a gross profit of $400,000. We take our gross profit and subtract our rent and our payroll, which for most board retailers is 75% or more of your expenses, essentially 2 areas. It's your rent you pay and your payroll. So we subtract the total expenses of $350, and we're getting a net profit of $50,000, which, if you're an LLC or a subchapter S corporation, you pay whatever rate your personal income is, typically around 30%. So you get the checkbook out and write $15,000 out to good Uncle Sam. There it is. Now let's take a look at this in a different way. Let's take a look at those exact same numbers from cash flow. What your bank account tells you. Cash in, cash out. Cash out is your purchases. You bought $700,000 at cost worth of merchandise. You had $350,000 worth of expenses. Your cash in were your sales of $1 million. Your cash out is $1,050,000. That's this. You just wrote a check out for $15,000 to pay the tax on the $50,000. but you still owed vendors or someone $50,000 in terms of in the hole, which would show up on your balance sheet. Now, Coco's been in business a long time. Coco, has this ever happened to you? Have you ever experienced this? Because I know for a lot of retailers, I have to tell you one quick thing a retailer told me many years ago that his dad said, I used to, business was so good in the past that I used to go borrow money from the bank to pay for my taxes. I'm sure that never happened to you, right, Coco?
You know what? It's really when our store, for example, for me, I love retail. I love fashion, and that's why I hired Management One to help me figure this out, because I'm not I'm not an accountant, and it makes more sense when you hire somebody to help you figure this out.
That's right, and it's nice to have someone on your side, I think, too. We're not accountants either, but we do know retail. And one of the things that we have in our reports, which I'll get to in a little bit, which I know Coco uses, is that we are monitoring this for our clients on a not only a monthly basis, but practically a weekly basis, so that we are coordinating our cash profits with our paper profits, which is very, very important, because the new financial reality today in retail is cash is king. Look, you can go, and many retailers do, we can go months and months and months without showing a profit. But you really can't go a day without having any cash. And that is what I think we have learned from the pandemic. Retailers that were not controlling their cash were the retailers that were most vulnerable during this pandemic. What we're talking about is we're looking at a cash margin number in terms of a KPI that is more important, we believe, than a gross margin dollar number, because gross margin dollars represent profit that can be still sitting on your walls and not sitting in your checkbook that you've sold. So that is one of the new KPIs that I think we need to look at. We need to measure. Now, I don't know how much, Coco, you look at your cost of goods purchased, but this is something that we believe is so important on our reports. For example, you can see in this particular example, we're not showing this retailer what their cost of goods sold are. We're showing them what your cost of goods purchased are for the last 3 months, for the last 6 months, for the last 12 months. And if it's sitting in these kind of numbers, this kind of territory of 40 to 45% cost of goods sold, generally speaking, you're going to have a good cash flow, as opposed to maybe another area of the store where you can see that this retailer for the last 12 months has a cost of goods sold of 58, 6 months 60, and the last 3 months 67%, which means that he is building inventory and it's affecting his cash flow because more and more stock is coming in. It's a critical measurement that in the past, too many retailers, I don't think, really looked at close enough. And yet it is absolutely critically important. And it gets back to our second KPI that I think is important, that's changing, because we have talked about gross margin return on investment for retailers for decades in terms of being a great measurement, because it is a measurement of time against margin in retail. In other words, it's how much money we had invested in inventory sitting there at any given point in time over the last year against what was that profit that we made. And that becomes a GMROI. But the problem with GMROI is that it suffers from the same problem we have from gross margin in general. It can be misleading. Consequently, a better view of return on your inventory investment is something called gross cash margin return on investment. How much cash you're producing in the business against how much cash you have tied up in inventory. Now, why is this important? And it's important because of a mindset that we need to have, and that all retailers need to have. So one of the questions that I often ask is, how many buyers are there in retail? And I ask, and at a seminar, I will ask people, if anyone that's a buyer, are you doing buying in retail, raise your hand. And everybody, of course, that is involved in the purchasing of merchandise for their store that they own or work for raises their hand. And then I say, well, there are no buyers in retail. there are only investors, because actually every one of you are investment brokers. Because as a retailer, you're not just buying merchandise, you're actually investing in merchandise. You are an investor in product. Because if you have buyers that work for you, and Coco, Coco, do you have a buyer that work for you, or do you do all the buying yourself?
I do all the buying.
You do all the buying. Well, so you understand more than anything, but other people that are on this call may have people that are spending their money. And and essentially what they've done is they've given you cash, that person cash, that they could have maybe theoretically said bought real estate or CDs, but you're a retailer. So that you're giving your buyers or yourself the money to invest in inventory. And those retailers have every right to ask, how well did you perform spending my money? And the answer to that is cash margin return on investment. That's really what you do. Now, the other thing that to look at is, how do you look at your measurement of inventory in terms of CMROI and inventory turnover? So I'm going to go through a little bit of an exercise with you that I know Coco's familiar with, but I'm going to go through this exercise with everybody on the call, because I think it really does help explain what CMROI really is. It's a very confusing part of retail. You know, CMROI it represents the dollar cash that you created for every dollar invested in inventory. So let's just say we look at vendors this way. And so we're just going to go through, and Coco, I want you to help me with this because you're going to be my assistant on this comparison. Is that okay?
Sure.
Okay, so let's go. Let's say Coco, you're buying from vendor A, and this is a big store, so vendor A, you know, because it does $500,000 in sales for your business every year. Really important vendor, and your gross margin on your cash margin is $240,000 or 48%. So it's a good vendor, right? It makes you a lot of money. And now we have vendor B, which also does the same amount of business, but in this case, our cash margin is $220,000 or 44%. Now, I just went through just telling everybody how important cash margin is. But cash margin is only part of the equation, because the next thing we need to look at, we're not done yet with our vendors. And this is the analysis really is important, because we need to look at how fast we rotated the inventory in and out of the store for vendor A. So our turnover in vendor A, let's just say, was twice a year. In other words, we rotated the vendor A inventory in total in and out of our retail store twice a year. But vendor B had a smaller margin, but we rotated that 4 times, or every 3 months. So what appeared to be vendor A, the obvious better vendor, because we made $20,000 more in profit, now starts to change as we look at turnover. So how does it change, and why does it change? Well, let's talk about this, and let's say vendor A had made that $240,000, vendor B made $220,000, made less money. But vendor A, we tied up $130,000 of our money in inventory that sat there over the course of the year, while vendor B only $70,000. So our ROI on vendor A was $1.84, and our ROI on vendor B was $3.14. Coco and I are neighbors. We have 2 houses next door to each other. So my house, I paid 20 years ago, these are inexpensive houses, so they're certainly not in Southern California, but let's say it's $130,000 that I paid for my house, and Coco bought her house like a week apart from mine. She was a great neighbor, by the way. She paid $70,000 for her house. We both sold our houses last week. I sold mine for $240,000. Coco sold hers for $220,000. Who got the better real estate deal? I sold mine for more than Coco did, but Coco only paid $70,000 for hers. Who's the better investor? This is it's not new, but this is the way retailers need to look at their business post-pandemic. It is the amount of cash that you have at risk tied up in inventory that is sitting there against the profit that it is making. And so this is part of what we're talking about at Management One as the new suite of metrics to start reviewing. We put it in our reporting in terms of our inventory health for our clients relative to what's your CMROI and what's your GMROI. And if we're a little confused of why it is that accessories got a CMROI of $4.13 and GMROI has a $5.12, what that is saying is that you are building your inventory up in accessories, but you're not getting the cash return, because if that continues, you're going to be paying taxes on a bunch of stuff that's still sitting there. That is what this report is saying. And this becomes, I think, for many retailers going forward, a Bible in terms of a new metric they have not looked at in the past, but has become more and more critical to start looking at in the future. Do you look at how fresh, Coco, do you look at how fresh your inventory is when you look at how much you have? Because that's another new metric. And I think we chatted about this, and that's something about not just knowing how much, but what's the current inventory valuation?
Very important to look at the numbers, but also, you know, our customers realize it too. They come in frequently, and they want to see what's fresh, what's new.
Absolutely right. By the way, you're exactly right, Coco. You know, I've always said, what do customers come in any store? It doesn't matter whether it's a board retailer or whatever you have. They essentially come in and ask for two things, right? What's new and what's on sale. And if you don't have either, you're kind of in trouble, right? But really, you know, we always looked at our inventory and said, how much do we have? But more and more people, you know, are looking at their inventory, not just how much you have, but how current is your inventory you have. I would encourage everybody that's on this webinar today to go back and identify the inventory in your store that's more than 4 months old. You know, if you have 20 in a board retailer business, if you have 20 to 30% of your overall inventory that's older than 4 months, you actually have a potential problem there. And if you have over 30, just go ahead, Doug.
That's what they call a fixture. That's no longer a product. That's a fixture in your store. If it's collecting dust on the shelf or in the case or on the wall, it's a fixture, and you have to have strategies to not only identify that, but to move that inventory and turn that inventory. And we have a lot of strategies like that through our vendor partners like Management One, and we can definitely provide some advice for you.
That is so, I love the fact that you said it's a fixture. We actually work with clients who are like in, they sell apparel, but they also have a home decor business, you know, Doug. And so they will have these expensive couches and tables that they never sell, but they put merchandise on them. And it actually really is a fixture. But unfortunately, what they do is they have it recorded as part of their inventory, which essentially means at the end of the year, they pay a tax on it, where if they would have categorized it as a fixture, they would never have to pay a tax on it. It still would be an asset on their balance sheet, but they never would have to pay
that too if it's a fixture.
Yes, very good point. And also they could depreciate it as a fixture. Mm-hmm. And people will ask me, and I'm sure, Doug, you've heard this too, well, but what if someone wants to come in and buy the table? Well, the answer to that is quite simple. Sell it to them. It's a free country. You can sell anything you want. You can bring it in. If somebody wants to buy one of your fixtures because they love the couch, they can. But at least, as you were saying, Doug, it's not being taxed. And this is something that's really, really important. That, you know, obviously the IRS has a rule that anything that's over a year old, you shouldn't count. Now, I don't think that has a major problem in the board industry, because I think you all probably turn your inventories pretty quick. But for some people, you know, the IRS is telling you, we don't need to tax you twice on that same piece of merchandise. And that's why the old thing, there's never a birthday party you never have a birthday party for inventory, is true. Because not only is it old and it's been there forever and is rat poison in terms of your customer, they see the same thing. But then at the end, assuming you're profitable, you pay a tax on it every year you count it. So very, very important, very, very important. And this is really, guys, it's all about turns. And, you know, I think, you know, I don't, you know, Coco, I don't want to bring you to, you know, throw you out here too much, because I know you have a lot to add. But when you started with Management One, probably one of the things, if I recall, is that you started with us for a reason. And that was, you know, how do I get my inventory to perform better? And the ultimate metric for that is your sell-through of your stock, or on a longer term basis, turns. Coco has nothing to say about that at all, so I'm going to keep going. By the way, here's the interesting thing about that too, Coco. One thing, and then I'll let you talk. Accounting does not factor in the element of time. You never see your turnover factor in accounting. Go ahead, Coco. Sorry.
You know what? It was 10 years ago, and I ran into, I don't know if you know how I ran into you guys, but it was at 10 years at a trade show, and I saw a fellow retailer who is very successful running a store, and I thought, what is he doing that I can do? We had just opened our store. I did not have a retail background. I was more on the wholesale side, and I saw him speaking with Management One, and that was 10 years ago, and I've never turned back. And I know this kind of, it may sound like an infomercial, but I cannot tell you guys how grateful I am to have you on my team. And I've been with the same consultants for 10 years. And they have helped me understand turnover and understand that, my passion is fashion and buying, and understanding that, yes, I can be laser focused on it and have somebody else helping me understand that if the turnover isn't there, focus my energies on something else, on a different category.
That's fabulous. I'm going to tell a story, okay, Coco? And this was actually a few years ago, and it was a chain of board stores in Australia. And they contacted us, and they said, we hear you guys are really, really good about helping, retailers, increase your sales, increase your cash flow, all of those good things by looking at your inventory maybe differently. And so we said, great, send us all your financials. And so we got literally, it was, I would say, Doug, it was like 500 pages long. I'm probably exaggerating, but he sent every financial. He had like 12 stores, every category in every store, and every single financial he sent from a merchandising perspective was margin. In other words, he said, and everyone, we went through it in every store, in every category and subcategory in every store, the margins never changed from either 47, 48% gross profit to 52, 53% gross profit. They all were in that neighborhood of about 6 points. And so, we said, we got a hold of him. We said, look, you've told us nothing. Right? I mean, Coco, this is the way, probably because one of the things we introduce is this whole concept of turnover. You've told us nothing about your business by the margin, because the margins are all the same. This is not why you reached out to us. What you forgot to put in is the most elementary part of retail, not your margin, but the inventory that produced that margin is everything. And that gets us into our next new metric. And it's none of these are new metrics, but they're metrics going forward based on keeping your liquidity there and keeping the inventory turning, which has a direct relationship to improving your sales. And we call that a stock to sales ratio. More important now than ever before. More significant in margin. Because if your margin's 48% in one category, but you have stock to sales of 2 to 1, which essentially you're turning it every 2 months. Or if you have another category that has a margin of 51%, slightly above the 48, but your stock to sales ratio is 5 to 1 or 5 months, what's the better category? It gets back again to the whole idea of the houses that Coco and I bought together. It's the same thing. It's not the higher margin, it's the category where you're turning it faster and you do not have as much of your capital tied up in unselling merchandise, which is really getting back to something that we think is very, very important, which is, how are you tracking your inventory right now? How are you tracking your inventory fluctuations right now? We need to look at inventory differently. Do we have enough? Do we have too much? And how do we know what that benchmark is? Now, here's a common mistake that I think a lot of retailers have been making that they need to stop right away. The common mistake in terms of inventory is that too many retailers hold too much inventory and don't flow in enough new inventory. In other words, the common mistake is we have too much, but we don't buy enough. Now, that may seem like a contradiction in terms, a little bit like jumbo shrimp, but that's the secret sauce on how to grow your business. That's the secret sauce on how to grow your cash flow. That's the insurance that we're looking for to not only survive the next crisis that comes down the pike, because the next crisis that comes down the pike may not be as compatible for our business, and maybe the board retail business may be the one affected more drastically than other verticals. That is the insurance we're looking for to survive any new crisis coming down the pike. Don't hold as much inventory, but buy more new. It makes sense. If you hold too much inventory, your capital is tied up in inventory sitting there. You don't want to buy as much. Why would you buy? You don't go and buy as much because you already have it there. That's been sitting and sitting and sitting. So everything is about fast turn, in and out, smaller quantities, turn faster, and a willingness to take decisive action on mistakes. Because again, it's not margin, it's cash flow. That's so very, very important. Doug?
From a retailer standpoint, and prior to being executive director of Board Retailers Association, I ran the USA operations for Mystery Skateboards and a few other skateboard hard goods companies. So I know it from that side of things, being a supplier or distributor. But prior to that, I owned and operated an indoor skateboard training facility where we had a core retail shop in the front and did lessons and camps and clinics and that kind of thing. And what was difficult, we liked, of course, the smaller orders, but we kept getting pulled into, gosh, if I did a dozen boards, I would get the 13th board for free. And gosh, the shipping on that's going to be more expensive. So the bigger the order, the better the situation. I can get a lower unit cost and the shipping is going to be lower over the amount of goods. And so what happens is I was ordering some dogs with the stars, right? And so maybe speak to that a little bit in terms of inventory turn and inventory tracking.
A great point. I think what it gets down to is the scary part of inventory management. There is a scary part of inventory management that we all have to admit kind of scares us a little bit, Doug. And that is the concept of narrow and deep. And here's why do I think that's scary? Because when you start to really narrow down your focus into what really sells and not be wide and thin, which covers this wide net, and that seems safer to a lot of people. And oh my gosh, if I narrow it down, but what if I'm wrong? And for the most cases, retailers know their customer. They're really not that wrong. And so when you buy narrow and deep, and be careful what you're buying, and understand, by the way, that the cost of carrying inventory that's not selling is a very, very real cost. And so when you are approached, as you said, Doug, by an incentive of a percentage off if you simply bought more, that actually can be calculated to find out if that's a good deal or not. And that's based on their 1% 1 week rule, which I'd be happy to talk to anybody who belongs to board retailers in terms of how that would work in terms of calculating. If someone comes to me and says, I will give you, if you buy more product, like you were talking about, Doug, and I will give you 10% off the order, then it becomes to calculate the additional cost of the inventory. I guess the 10%, that is a formula that you can use to decide, is that a good deal for my business? Because I don't want to buy more and have that excess inventory chew up that 10% very, very quickly, which it can do in terms of carrying costs. So that's kind of, and plus you then, as you said too, Doug, you're getting away from narrow and deep. I mean, to buy more, you're suddenly going back into wide and thin, and that's also going to kill you in terms of your markdown. So that's a great example, which was good timing, right into the narrow and deep thing. I think, look, there's an old thing about 80-20 rule in retail, right? It's called Pareto's rule. 80% of your sales come from 20% of your inventory. Well, we have to kill that right now. We have to take it out in the back and shoot it. I mean, right now that cannot work for retailers. Now it's about narrow and deep is mandatory, because we know that in your assortment, and Doug, you knew this, and Coco, you know this too as a retailer, just a handful of SKUs can dominate a classification. Just a few styles and a narrow array of colors can be absolutely significant to your business. And just on the best sizes, please, because you can't please everybody. So broad and thin and a wide net is not playing it safe. It's deadly, particularly now. I have an example of how this happens, by the way. Coco, you want to see it? I don't think I've ever showed you this. This is a good one, by the way. Okay, you guys ready? Doug?
Absolutely. Here we go.
Okay. All right. Well, let's say that I've got a store. I own a store. All I sell is pens. That's all I sell. And so I want to know how I can keep my pen inventory in perfect condition. So, for example, I'm going to forecast that I'm going to sell 12 pens in my store this month. So knowing I'm going to sell 12 pens, how many pens would I need to have in stock to be in the perfect condition of inventory of pens? Doug, Coco, anybody want to take a guess? If I'm going to sell 12, how many am I going to need?
20.
Coco?
I would say you're gonna need 24.
See, they both were saying, Paul, we weren't told there would be a test today. This is new for us. No, you're both wrong, because to be in the perfect condition, we only need 12 to sell 12. Now, I have a little wrinkle for you. That pen that I'm going to sell 12 of comes in 12 colors. So if they come in 12 colors, how many do I need now, knowing that pen comes in 12 colors?
Do all 12 colors sell equally?
Well, we're going to make sure that we have, because we don't know. And so we're going to, if we're going to have 12, we need 144 pens, Doug. We need 144 pens. By the way, the pen comes in a longer size pen and a shorter size pen, and those two sizes come each in 12 colors also. So let's write the order, but we'll need 288, right, to cover ourselves? Well, 288. How much? I know you would do this, but this is an extreme example of how we get into a wide and thin overstock condition, because if we did that, we'd have 288, and we're going to sell 12.
Be nuts.
That would be nuts. That would be crazy. And it's an extreme example, but it is an example of how this can happen, where we try to carry too much, and that is called wide and thin, that wide net. How many should we have if we were going to have? Actually, I was very harsh with both of my students today, everybody, because both of their answers are actually quite correct. I think Doug said 20 and Coco said 24. Both are good answers, because both are saying, I want to keep about anywhere from a 2-month to a month-and-a-half supply of pens. Now that again would be based on how easily I can get my reorders back in and my lead times. But that is based, both Coco and Doug's answers were actually the correct answers, because that you need to determine your inventory based on time, on every element about time, from how much inventory should I keep based on how fast I can sell it, time, to what's my lead time, how quickly can I get inventory back in. Time is the ultimate denominator in how you really get your inventory in shape. Now, one of the things that we believe is that we look at is we need to narrow our focus down, because I think looking at for a year or even 6 months is maybe too much. So one of the things we believe at Management One is we need to condense that window of focus, and maybe we need to look at everything within 12 weeks and 12-week cash flow. So we are offering this on our website, that you can go on our website, and it's a free, very simple Excel template that you can fill in, which will show you your 12-week cash flow based on cash in, cash out, on your overhead and on your purchases of merchandise. And again, you can see where you can go into management-1.com 12-week cash flow tool, and that's all free to be downloaded. Now, I do think we need to talk about markdowns. I know we don't like to talk about markdowns too much, but they are a cost of doing business. They are how we learn from our mistakes. And I think that we don't really learn anything in life unless we make mistakes. Now, I know this is hard for Doug and Coco to believe, but I actually have made mistakes in my life.
Come on.
No, I'm not being serious now. I know. You're saying, don't lie to us, Paul. But it actually is how we learn. And so when you take a markdown because you made a mistake, it's a learning experience. I often equate markdowns to like tuition that you paid for, paying your tuition for your education or your understanding of your customer. So markdowns in many ways can be a good thing. Now, I think that for some quarters, markdowns are considered the ultimate evil. I think that an accountant would tell you that if you mark things down, you're losing money, so you should never mark down. That's not realistic, but you may have heard that in the past. Markdowns are a part of your doing business. But here's the thing that we need to understand in terms of a look at our markdowns that we take in the store. Markdowns are not a zero-sum game. Now, what do I mean by that? Well, I think that from maybe an accountant's perspective, and I'm saying this is not all accountants, but from the accountant that might say, if you take markdowns, you're losing money, so don't take markdowns. That would be a zero-sum game. But the fact of the matter is that a retail business is very robust in changing on a daily and weekly basis. And so the markdowns that we take would only be a zero-sum game if those shelves that are empty now were full of merchandise that didn't sell and we marked them all down. But they're not, because you're going to replace that. You're going to bring in new products that will sell better, that will mitigate those markdowns you took. It's not a zero-sum game. We do refill the shelves, and it's important to do so. Fallacy number 2 is if you take markdowns, they're only going to, oh, Coco, you take markdowns in that store. You are training your customer to only buy when you mark it down. Anybody ever hear that?
Mm-hmm.
Only when if you start taking markdowns all the time, Paul, my goodness gracious, they'll just wait you out.
Especially if you do it regularly.
Correct. Now, this is when this will happen, by the way. It's not necessarily a total fallacy. This can happen. Here's how it happens, I believe, in my heart of hearts. You do 2 things wrong. Number 1, you never take markdowns to the end of the season. You have an abundance of merchandise that didn't sell because you bought too much. And so your markdown, your gigantic clearance sale that you run, say, in August, just to say, is huge, and you get rid of all of it. But then your July sales become weaker because why would they buy anything at full price in July if you know you're going to run a huge sale in August?
Mm-hmm.
So if you start training them to wait for your giant sales, because you're saying, I'm only going to mark down twice a year, you're also training them to wait for that sale. So that's number 1. Number 2 is, and this is a more common, I think, in today's retail. If you are timid on your in-season markdowns, on your mistakes, you are then training the customer to buy only on sale. What do I mean by that? And you see this all the time in retail stores. You walk in and you see a rack, and that rack's 10% off. Or that rack over there is 15, or you have an item that was $110, it marked it down to $99. Those are called timid markdowns. Those are markdowns based on, I still want to make money on it. And one of the first things that we need to understand is when we have a problem piece of merchandise, forget about profits, because let's get back to the overall theme of this webinar. We want to have cash flow. And so we want to cash out as quickly as can to bring something that will sell better and more profitably and get it off the floor. Because if you are wise about taking aggressive markdowns, most of the mistakes you made will be gone before most of your customers would know they were even marked down to begin with. But timid markdowns stay longer on the floor, which means that a larger and larger percentage of your selling floor is on things that was 100, now 89.99, or was 50, now 39, or 44.99, or, look, at Christmas time 2 years ago in 2019, they did a survey for women in shopping centers. They asked them, what would it take in terms of a percentage off markdown for you to go into a store you normally wouldn't shop in? You know what the answer was? 40%. So the idea that you can get a small, you're trying to you milk out a profit on bad merchandise and mistakes is wrong, and it is super damaging for you. Because there's an art and science. Go ahead, Coco, sorry.
Oh, no, I just wanted to throw out there, as soon as we see that something is a slow seller, we'll analyze to put it to mark it down. But before marking it down, we check with our vendors to see if we can return it for something that's selling, because ultimately they don't want to see their brand on sale. And so I recommend contacting the vendor and swapping it out for something that will move, because maybe something that's selling in not selling in your store is selling in a different part of the country in that particular for that particular brand. So for brand integrity, I think it's important to, before marking it down 40%, checking to see if you can return it.
That's a great point.
Absolutely.
Yep. Great point, Coco.
That's absolutely, absolutely, absolutely the reason that you want to establish long-lasting relationships with your vendors, is to be able to provide that feedback that is not one-sided. It's very important that you establish that relationship to do just that, and Coco does a great job in it. I've definitely seen that, and many of our other retailers do that. In some cases, you don't buy enough to establish that relationship, and the vendor's a little bit less likely to take things back. And in those cases, before marking it down physically and letting the world know through social media, Instagram, Facebook, whatever, hey, we're on sale X percentage or any of that, I would, as a retailer myself, I would convey that to the people working behind the desk, behind the counter, and have them convey it personally when they're talking to customers coming in, having that conversation with them, identifying kind of what they're looking for, and then bringing those to them, saying, you know what, there's something that I can probably do a really, really great deal on today that might make some sense for what you guys are looking for. And that kind of helps you push through before you have to physically mark it down. And there are a couple of other strategies that I used when I was a retailer to avoid the markdown, using raffling at events and using the raffle proceeds to purchase slow moving product without, for full retail price, so that I wouldn't lose the margin on that type of situation.
That's great points. There are lots of things that retailers can do before they take the necessary, if the step is necessary, to necessarily take a markdown. I mean, you can do spiffs on it too, right, Doug? I mean, you could maybe motivate your people by giving them a commission. Can you sell this for me? It's not selling. Typically, this works better on higher end goods, higher ticketed items. But there's anything you can do, moving goods around on the floor before. Markdowns are the last resort. But sometimes they are the resort you do have to take. I like the idea of going to your vendors, by the way, particularly if it's early in the season where they're still shipping it out. If you can recognize that this was going to be a problem for you as quickly as you can, then a lot of these vendors will take it back because they can still put it into their shipping cycle to other retailers around the country. So that's a great point too. Once we get into the fact that, okay, they're not going to take it, it's just not going to sell no matter how much we try. Then there is an art and science, I think, on taking markdowns that can help everybody. First of all, we should have a budget. We should know how many markdowns we can take. And so how much business can we do? How much business are we going to plan to do? And then what is our gross profit and what's our initial markup? And from that, we can get a markdown budget. For example, if you have a store that does $800,000 in sales and you want a 50% profit, then you're open to buy. Very simplistic open to buy would be, I do $800,000 in sales. Over the course of the year, I will invest $400,000 cost inventory, right? Just buy $400,000, sell it for double. So you sell it for $800,000. But on those purchases, my initial markup was actually 2.5 or $1 million. So the difference between $1 million and $800,000 is $200,000. That's essentially how you come up with a dollar budget. So then at least am I taking enough, too many, too little, that type of thing. And then I think there's some things that, once we get into that situation where we're going to mark down, is what I hate to see is just a rack right of sale. So this is on sale. And I think it's important is that we give a reason why it's on sale. Otherwise, I think we are going to run into a problem with our customer that would say, well, if this is on sale, but you didn't tell me why, so when's that rack going to be on sale? So I do think it's important to say end of season, damaged goods, whatever the reason, weekend special, doesn't matter. Just, I think a reason why it's on sale is important. The first markdown is the cheapest is an old adage in retail, but it means if it works. If that first markdown will sell it, then it's the cheapest, not that it's because the first markdown is so light. And then also a little bit of psychology, guys, on this one too, because we were born and we learned to count from left to right. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You can kind of picture that from left to right. Well, because of that psychology, we expect lower prices to be on the left and the higher prices on the right. Believe it or not, I did look this up, but that is a little bit of psychology in terms of when you do price it on sale. Make sure that the sale price is to the left of the full price. And I would stay away from percentage off as best you can. Now, that's sometimes hard to do. But percentage off can be very, very dangerous in terms of, as I said, now the customer wants it only at 40% off. I mean, it's a little bit like an addiction, you know, where an addiction is the first time you try it, it's great, and then you chase that first hit, so to speak, so that and you always need more and more and more to get that same satisfaction. Well, I think percentage off is the same thing. 10, 15, 20% off, tried it, done it, did it, I need more. And so if we can stay away from percentage off, and also use the word save, Coco and Doug, you know, putting saving, instead of spending money, try to essentially say, I saved $25 on this rack this week, on every item on that rack. Then you are accentuating a positive for the customer, not a negative in terms of what they're spending, but it's how much they're saving. And I think the last thing is so important is learning. That is absolutely critical. We need every markdown. We need to learn why we took it. So, guys, go ahead,
Quick
Doug.
question on that, Paul. What's your take on add-ons in terms of, you know, kind of buy one get one discounted?
Love it.
Things like if you purchase X amount of product, then you get this at. What's your take on that type of situation?
Love it. Love it. I love BOGO. Buy one get one. Right. Here's the thing. People prefer, if you couch that to if you buy 5, get 1 free. There have been studies on that where people prefer the idea of getting something for free to a much greater extent than a discount. So in other words, the studies have said if you can couch it, say, if you buy 3, you get this one for free as the 4th one will throw in. That would be, all things being equal on prices, more important to a consumer than 20, 25% off. And so that gets back to what you're saying too, Doug, about the BOGO, buy one, get one. Those are very, very, plus you can move more units too out. So those are very, very effective markdown strategies. You know, at some point, if I ever get invited back, we can go through I would love to do it for everybody on the calls, to go through a whole hour on terms of pricing psychology. It's a fun presentation, and I think everybody would get a big kick out of it.
Well, we have these collaborative management one Board Retailers Association webinars on a quarterly basis, and so let's plan accordingly.
There we go.
I believe that topic in itself, pricing strategy. I mean, in college I took an entire class on pricing strategy, and so.
Oh my God, we'd have fun with it. We'd have fun with it. Coco, you want to do it? You want to do it, Coco?
Yeah, I love it.
Right.
Yeah.
All right. It's done. It's done, Doug. Okay. So I want to wrap it. I want to wrap it up a little bit. What am I talking about here? I'm actually talking about when you look at your business, instead of looking necessarily at your income statement, look at your balance sheet. I think the balance sheet's been underestimated by independent retailers. We do look at our income statement. We want to know if we made money or not. But as I've tried to show you, that sometimes your income statement can show you're making money and you're really not cash flowing. Balance sheet measures the financial health of your business. It's kind of, and look at cash margin. Look at cash margin return on investment and your inventory, not just how much you have, but how much of it's new and how much of it is old and aged. And by the way, if you want to turn your inventory, don't just look at margin. Look at the ratio of inventory to sales all the time. Those stock ratios are incredibly important measurements in retail and are more important now than ever. And again, understanding the role of markdowns to a greater extent, I think going forward relative to our cash position is critical. And then finally, I think, everything we need to look at needs to be now, real time. I think daily, weekly, as much as necessary. But the key here, I think, in everybody, and, I love the fact that Coco said, she was kind of intrigued when she met us at a trade show. And I think at some point, Coco, like so many of our clients, decided that I'm going to start using data to make decisions and not just wing it all the time. And that's important, because if you don't know where you're going, any road will get you there. I do not, Doug, want to overstay my welcome. I know it's over an hour now, and we promised it would only be an hour. So I want to thank everybody. And, look, knowledge is liberating. Are you gonna really fight for your business? It's not, as Dwight Eisenhower said, it's not the dog in the fight, it's the fight in the dog.
I want to throw out there, if it's okay. I think as retailers, we're in this business because we love fashion, whatever it is. And there's so much going on with social media. so many different celebrities, musicians, we're trying to find the right trends. And if you're with the right team, you can your store will succeed with the right people helping you set your goals and make those goals.
Absolutely right. Thanks, Coco. And Doug, do we have time to open up for any questions, or?
Yeah, we still have a number of attendees in attendance, so let's go with it. Let's see what questions.
And again, we are going to have a recording available, so I do appreciate everybody staying on a little bit over, especially our panelists. But the recording is going to be available if you do need to step out. We do have a couple of questions. The first one, Sean is asking, where can I find those spreadsheets with the new metrics? Oh, I think he's referring, so Paul, in your presentation, you had a couple of plans that you were showing a lot of the different metrics that we're looking at. So that's actually our proprietary software called Retail Orbit. We did have a screen a couple of slides ago, and that's what our retail experts use to really analyze and get in super, super granular into the data each month. And Coco might actually be able to speak to a little bit of Retail Orbit on that front.
As far as?
Just how deep you can actually go into the retail data.
Oh, well, that's something that I do with John Adams and Alan Roseman, and we look at once a month we have 2-hour meetings, and then every week we have meetings internally here. We call Tactical Thursdays, and we just look at the data. And we just focus on the numbers. We look at the data. We look at to see how fast things are selling, how slow they are, and we like to call them promotions, not markdowns. So we do our promotions. Sounds better. And yeah, those reports are invaluable. They are in with me at all times.
You know, I just thought when you mentioned promotions instead of discounts or sales, Coco, I just thought about the benefit of rewarding your loyal customers that come in a few times a year, customers that are making comments on your Instagram, customers that are really your allies, and rewarding them with a special deal. And that might be another solution to some of the markdown stuff that we talked about previously in terms of, hey, you're a really loyal customer, so we're willing to do this for you.
Can I jump in on that, Doug? Because you just hit on something that I really believe in. Instead of even giving him a special discount, give it to him for free. I know that sounds crazy, but people who look, nobody loves free. Everybody loves free more than anything. I go to a trade show, Doug, and you give me the swag bag. I'm all excited. And all it is a cheap T-shirt and some stupid pens, right? But I am thrilled because I didn't have to pay for it. Most people actually love to be given a present, and it needs to be unexpected, by the way, too. So if you bring home your wife flowers on Valentine's Day, that's a nice thing to do. If you bring home your wife flowers today because there's no reason for it other than you love her, that's an amazing thing you just did and have much greater impact. Sometimes, and I like, Doug, what you said, sometimes you have things that aren't selling, and it's not and so instead of marking them down, it may be just better just to, as a good customer comes in, Doug, like you were saying, just hand them this and go, by the way, I'm going to throw this in the bag. I want you to have it. There's no charge. I appreciate you. I appreciate how you supported the store over the years. And this is just a present that we will give you. That will do more for your business in terms of the brand and the association of generosity than just marking it down. So that's something also you might want to consider.
Absolutely. And the other extension of that program, and really any loyalty program that is remarkable, Seth Godin says, if you're not remarkable, you're invisible. If it's a situation where someone really values that and they're stoked on that free item and what you've done for them and their kids over the years and all that stuff, they're going to post about it. They're going to comment about it. They're going to be like, hey, go to Surf Diva, take surf lessons, buy all their new stuff. Do you know they have coffee now? It's those kind of things, and it gets people really excited. And so really value your extended family. In the surf world, it's Ohana, and skate shops, wakeboard shops, snowboard shops, you value your customer and really, figure out ways to make them feel like family, while at the same time not giving away the store, and making sure that you have those tools in place that Management One puts together for you and other sporting vendor partners, Board Retailers Association can do to help you lower costs and increase margins and turn and make more remarkable customer experiences.
I call it, Doug, instead of market share, it's share of heart. You want a big share of your customer's heart. They want to love. There's no reason why they have to do business with you. There's lots of places where they can buy the stuff you sell. But if you do those things, Doug, exactly what you're saying, and the things that Coco does in her store too, by the way, at Surf Diva, those are the things that you develop a share of heart of your customers. That's when you really have a successful retail store.
I would also argue that that's the strongest weapon for independent retailers versus big box stores and behemoths like Amazon. They simply can't compete with the independent retails on that share of heart, on that emotional connection that they have with their customers, especially board retailers. They're almost like they're the neighborhood shop. If they're a skate shop, that's your neighborhood skate shop.
Really,
Amazon.
you're absolutely right, Nico. Especially the skate shops, the surf shops, all board sport specialty retailers really create and sustain that scene. They're not just another outlet for whatever good or service. And that's why when the pandemic happened, pre-pandemic, some people thought, oh gosh, all this e-commerce and Amazon and blah, 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 it's really hurting us as a retailer and that kind of thing. Pandemic happened, and what did it do? It actually strengthened, in some cases, independent retail and really showed that it's not going anywhere. You've created that brand in your area and with your customer base, and as long as you're taking the right steps and making sure that you're not exceeding certain metrics and not and meeting other metrics, then it would be a situation where you're really not doing it. But as long as you're taking those steps, then you're in good shape and continue to move forward on that.
Yep. So final question, and I promise I'll let you all go after this. Final question, Patty's asking, how often do I need to review all of these metrics that you presented? I think Coco actually kind of alluded to it. With Management One, she works with her retail experts once a month, but she also has weekly tactical meetings. So it really depends on bandwidth, I think, and what works best for you. I would think once a month would be baseline, but I think that's really the strength of Management One. A lot of folks, when you're doing this by yourself, you don't have a lot of bandwidth. So working together with a retail expert at least once a month is really something that is invaluable to our clients, and we feel it is invaluable to many independent retailers across the country.
Agreed.
Excellent. Well, that was it for our question. Yes.
I have a question that a lot of board specialty retailers have posed to me. They see some of our special offerings from our sporting vendor partners, and they, in a lot of cases, I remember when I was a retailer, I would have 10,000 things going at any given time, and it was hard to focus on one thing, and I had to really justify, okay, if I'm going to spend my time or even reach out to this vendor that's not directly in this space right here, it has to be a real value. The cost has to be low and the return has to be high. And a lot of people have misconceptions about the costs and benefits related to retail consulting and to, what Management One does and things along those lines. So maybe you could elaborate on that to, basically diffuse some of those misconceptions.
Absolutely. I think I'm going to defer that one to Paul, because Paul has a great way of characterizing the value.
Well, yeah. First of all, whatever you spend, first of all, our fees are very affordable. Let's start with that. We have 1,200 clients around the globe, and 50% of the clients are just like Coco. They have one store. And so 50% of our clients are single store. Almost every one of our clients is a family-owned business. We don't work with the chains. We don't have the kind of fees that consulting companies would have that if they worked with the chain. So our fees are very affordable, and they're based on how big you are. If you're a small little store, you pay us the smallest fee, and and depending on your size, the fee is commensurate with that. Our fees are also based on results. We are month-to-month service, so one of the things that I think is important to understand is that you have zero risk working with us. If this is something that you sounded good, and then you start with us and you go, well, it sounded better than the reality, so I don't think I'm going to go forward with Management One. First of all, that when I say never happens, I actually do mean that never happens. But if it did, you would have spent very little money. And but most of our clients stay with a long, long time for the very reasons that Coco has said. It is a lonely, lonely business being an independent retailer, right, Coco? I mean, you have to have someone from the outside that has the exact same objective you have, which is to grow your business, to have better cash flow, maybe open more stores, whatever your objectives are, that's our objectives, is invaluable. Because in most independent retailers' lives, everybody that's in their lives may have a different agenda. The bank has a different agenda. The vendors have a different agenda. The salespeople, your accountant has a different agenda. Your spouse may even have a different. Your spouse may not even be happy that you have this store. But one of the things with Management One is we're going to work doubly hard because the onus is on us. It is completely, we are accountable to our clients because Coco could drop tomorrow if she wanted to. She doesn't need to keep paying us. And that's true with every one of our clients. We have 1,200 clients. We lose maybe 30 clients a year. And any of them could leave at any time. The point of the matter is, so we work very hard to get results for our clients. And for the vast majority, we get those results.
Love it. Well, that was it for our questions. I definitely want to thank our panelists for coming on today, staying on a little bit extra. Doug, we always appreciate collaborating with you guys on this quarterly education session. And Coco, thank you so much for bringing up first-person perspective to some of the dialogue. And Mr. Erickson, as always, the education you provide is invaluable. As I mentioned before, we are going to have a recording up, and Doug, there will be a special place, correct me if I'm wrong, on the BRA website to house the recording?
Absolutely, absolutely. What we'll do is we'll post a new advertorial with not only this recording, but the recording from the first collaborative Management One Board Retailers Association webinar from 2021. We'll have links to those, as well as, if you guys want, we can do the links to the spreadsheet and a couple of other things and the way to connect directly to Paul and to the Management One folks.
Fantastic. And it looks like we have a topic for our next one. So we look forward to seeing everybody next quarter when we're going to discuss the psychology behind pricing.
Great.
Thanks again, folks.
Bye.
Have a great day.